Good morning and a very warm welcome to this session. I know a lot of you are looking forward to this conversation with Haresh and Saurabh because it's on a theme that certainly has stoked the public imagination, fired the public imagination here as well. We have a whole slew of companies who are kind of preparing to hit the Indian public markets. Internet companies, and as our hosts were describing, it perhaps represents in some ways a new India rising. Is that the case, or is this likely to be a mirage? I know there are skeptics as well out there who believe that perhaps we're, how is it that companies that don't have a sustainable business model are getting this kind of rich valuations? We'll discuss that and unpack what lies at the behind this whole phenomena, and dive a little into what kind of an investing approach will really work for you because this is a conversation focused around investment. And with Haresh and Saurabh, both of them don't need any introductions. They will also offer a peek into what the future holds as far as this new economy is concerned. So before I kind of bring them in and welcome Haresh and welcome Saurabh, great to have you guys.
Thanks, Indrajit. Thank you.
Great to be here.
We had one small segment planned before we dive into the conversation with Haresh and Saurabh. That's with Kaustubh Belapurakar, who is our director for fund research at Morningstar. Some months ago at Founding Fuel, we kind of had a conversation with Aditya and Kaustubh at Morningstar to try and see if there was merit in looking at data, a data-driven approach of internet IPOs around the world and how they have performed since 2009, at least the major ones, across the world. And I mean the US, China, Europe, and other parts of Asia, Australia as well. And I think many weeks later, we do have a good sense of what they point us to in some ways. So Kaustubh will share his perspective. Hi, Kaustubh, good to have you.
Hi, thanks, Indrajit.
Yeah, so this report I know is still work in progress, but it'll be great for you to just set context on what's really happened around the world if we were to study the performance of the internet IPOs. So over to you, a short peek into what your report is throwing up.
Perfect. So thank you so much, Indrajit, and thanks for setting the context. I'm just going to run through a very quick finding study of what we've seen as Indrajit outlined. So essentially, what's happened over the last, and we looked at data across the globe, since 2009 for internet company IPOs. And some interesting trends and probably some predictable trends coming out, right? So the first thing that you obviously notice that probably about since 2009 till June 2021, where we looked at the data, there were about 270 odd companies that made the cut on looking at qualifiers like we've listed here, $100 million at listing at least, and it's across the curve, right? So when you think about the internet space, it comes from industries such as obviously there's electronic gaming, multimedia, and entertainment. There's usual suspects of internet retail, there's internet content and information, your typical social media sort of classified companies or apps. You have your internet technology services and software applications, your payment platforms or the backbone to your commerce platforms, which are typical examples in that space. And then you have your travel services companies, be it your booking portals or taxi services, right? So it's a kind of a good mix of varying type of internet IPOs that have come out, and across this is from across the globe, right? So obviously the US has been in the forefront. We all know that it's really the hotbed for a lot of this ideation and creation of companies. But we've increasingly obviously seen a lot of listings come in from developed Europe, including the United Kingdom. China has been to the forefront, and a large part of that has also come out through the mobile gaming sort of companies. But we've also seen splattering interest from be it Australia, New Zealand, and other parts of the world. So I think it's an interesting mix. And let me just dive into some of the trends that we've seen in terms of what's happened to these companies in terms of post-listing, right? And I think that's always the first question that comes to an investor's mind when he or she thinks about, hey, here's this internet IPO or this stock, and there's obviously a lot of chatter on the street that look, valuations, business models, and how is it really, is there enough on the table for me as an investor to make money from that IPO, right? So what we decided to do is look at what have been the price movement trends for these, these companies that we studied over a 1, 3, 5 year basis. That's really outlined for you here, right? So when you look at it, the overall market cap for these stocks has obviously grown quite significantly, from about, close to about 2 trillion to about 4.3 trillion. When we look at it, so that's almost a 1.20% growth, right? And even when you look at the charts, you can see that the average return for these stocks looks pretty good, right? I mean, the CAGR is in excess of 20% over various time periods. But the one thing that this doesn't tell you, and which we'll elaborate through, is that while the average returns have been good, it's really been skewed by those few stocks that have done exceptionally well over this period of time. And when you look at the median returns, you can clearly see over various time frames, the median company has actually delivered subpar single-digit, low single-digit returns, even over a 5-year basis. And in fact, most of the time, or half the time, over a 1, 3 year basis, these stocks are actually trading below sort of their listing prices. On a 5-year basis, it's probably a tad better at 40%, which are trading below the listing prices. But that is really the moot point that you have to look at the companies from the perspective, obviously, at what they're being valued at, and what is the business model going forward. Which is, I think, very important, that you can't use a one-size-fits-all sort of solution. You need to do that deep dive, and that's what data is also supporting, right? And when we look at slicing and dicing this information, so we looked at the overall picture. When we think of it from a perspective of, are there any pockets of opportunities or pockets that have done well globally? There's some interesting trends that come out, right? So your typical information technology and services company, so which would be your payment platforms, your e-commerce sort of SaaS, the backbone platforms. Here are some listings that are done pretty well. Not just when you look at it, that a few companies that have done exceptionally well, obviously there are those in the space, but as a sort of rule of thumb, a lot of them have generally done well, even when you look at the median returns, and that's where even the success ratio of these companies stands pretty well, right? I mean, obviously we all know the facts that the internet sort of e-commerce is booming, payments are moving online, and this has kind of resulted in revenues for some of these companies growing quite exceptionally over, since listing too. At the other end of the spectrum, what we've seen with the travel services companies, I think that's been more challenging, where we've seen a lot of these have either kind of struggled or degrown in terms of price, and that's only been further exacerbated by the COVID-led crisis, where obviously revenues have fallen off the cliff for a lot of these, albeit I think they're slowly coming back in terms of revenge consumption, right? But that is a trend that's clearly there. The third space that's interesting is the internet retail. Now, we are all aware of the big elephant in the room, the Amazons of the world, which really rules a lot of the world in terms of the e-commerce. But the interesting bit is that in the internet retail space, a lot of these specialized online retailers, be it cars, secondhand car retail, be it fashion, be it sort of beauty products. A lot of these have actually listed, and some of them have also done well. So the specialized retailers, the food delivery, which is also a part of the internet retail space, there are a couple of them, global listings that have done reasonably well since listing. So that's kind of the broader perspective from a industry breakdown. Now, the other thesis, right, is that how do you think about it from the perspective of when a company lists? Is it too early in the cycle, or is it too late in terms of listing? Is there enough on the table for investors, right? So we've just done a breakup by market capitalization at the time of listing for these companies, and I think a couple of key trends that come about, right? So one is clearly what you can see is the mid-cap companies. Some companies which have probably had a good, well-established track record already are listing probably at the sweet spot in their business life cycle. There's enough on the table in terms of exponential revenue growth continuing going forward, and that's really the segment of the market that's done relatively much better than as you would compare with the large caps, which obviously some of them have done, some of the large caps also did exceedingly well, but as a group, it's really the mid cap stocks that have done well across the board, as you can see from the data. Again, at the other end of the spectrum, small caps, a lot of these companies, probably trendy companies with really an unproven proof of concept. I mean, the concept seems good, but has it truly related or translated into revenues? That's something which you can see from the data that it has been a challenge for a lot of small cap companies, also having listed at reasonably elevated price to sales multiples, and they've seen a fair bit of erosion in market cap. And what you can see, it's not just a few, but quite a few of the small caps have actually struggled to add value in a 5-year perspective, right? So I'm just going to leave you, before I hand it over to Indrajit, with some of the names that have done exceedingly well, and this is just for your information, which pulls out the perspective that when we say the winner takes all, here are some companies that have really created value for their investors, from a stock price perspective. Obviously, a lot of them have also seen significant revenue growth through the journey since listing. So I think there's some interesting names here. You can see the typical examples of your internet e-commerce sort of platforms. Your Shopify, a name that we all kind of relate to, being the backbone for a lot of internet businesses. You have a lot of payment platforms. Your buy now, pay later, your afterpay. You have an internet retail, an auto second-hand auto retailer like Carvana, which is really significantly up to this game, since its listing. So I think it's a good mix across industries and geographies, as you can see here. So the point being that you have to, you can't paint everything with the same brush, and I'll leave it to the good officers of Indrajit, Haresh, and Saurabh to kind of discuss through what they see from an Indian perspective. But what the trends seem to suggest is that you have to be very, very picky with the IPOs you get into. Understanding the business models, getting into the right valuations would be key to really making money, in that. So with that, thank you so much, and Indrajit, back to you.
Thank you, Kaustubh. That's given us, I think, certainly a lot of food for thought and set the context for the conversation with Haresh and Saurabh. And I wanted to start with asking both of them if there were any initial reactions that they'd have to the points that Kaustubh made in his global study. And then we'll dive into what this means for India and where does India really stand. Haresh, do you want to go first? Any initial comments?
Yeah, initial comments are essentially that, what you can see is that when these companies go into an existing industry and reshape it, Kaustubh talked about you have to be careful about which IPOs and unicorns to invest in. I'm sure Saurabh will have much more detail and data and foresight on what to do there. But I'm saying overall, when you see that when these players come in, they don't compete in the industry, they reshape the industry. So I thought, that's important to understand that when Shopify emerges or Afterpay comes in, they are transforming already existing behavior, scaling it and multiplying it with the depth of information and data they have. So in that sense, we need to keep that in context when we analyze the business model. Is it something that's going to change consumer behavior? And therefore that's can be hugely valuable, but also hugely risky. Or is it going on existing behavior? And the second thing, it's interesting that we're doing in this conference in the week that Tesla became $1 trillion company. Now, if you compare it with BMW, it sells 1/3 the cars and has a market cap that's 20 times higher. So essentially, if you look at a per car sales multiple, 60 times higher than BMW. So is it a software company? Is it a car company? I think that's the other factor to keep in mind, that how these companies have the ability to morph. For example, if you look at Nykaa, that's coming up. Now, I'm not going to comment on the valuation. I'll leave it to the rest of the panel to talk about that. But if it's successful in the cosmetic space or personal care space, if it becomes equally successful in selling apparel, for example, you completely transform its valuation, its attractiveness, its unit economics. And that's what you need to keep in mind, that these companies have the ability to morph and reshape industries and completely rewrite the competitive dynamics there. So I think that's the only thing to remember. Mid cap, large cap, all these are secondary issues. I think what we need to really look at is that there is a new context that's come in, actually. And companies survive and thrive in context. The new context post-COVID is of a fully digital world where consumer adoption has scaled at much faster rate than companies have been able to digitally transform themselves. So therefore, that the winner-loser paradigm is the other thing. I mean, if you have 50 listed internet companies tomorrow in India, let's say 2 years later, your challenge will be, should I be in an internet company or should I be in a traditional company? And then within the internet companies, which one should I choose? So I think that's the big paradigm that probably Saurabh can comment on more.
We'll pick up that, Haresh, in some more detail. Saurabh, your takeaways from the study?
I think a lot of credit to Kaustubh and his colleagues for putting it together. Very interesting collection of data. I think it brought home 3 points to me, which I thought sort of tallied with a lot of what we see in India, but Kaustubh very nicely put it in the global context. The first is it's intriguing how few internet or tech IPOs there have been, right? Remember, we're looking at an 11-year period, 270 IPOs for the world as a whole. That means, something like 25 IPOs for the world as a whole, roughly 10 major stock markets in the world. That means only 2.5 IPOs per year in this age of technology. So very intriguing that how few tech IPOs actually have been, right? Which underscores, I think, 2 other points. That's the second point I sort of picked up, which is fundamentally successful tech businesses actually don't need that much capital, right? And I think the most extreme way to think about it is there's a lovely book called Capitalism Without Capital. I think 2 British economists wrote the book around 3-4 years ago, Jonathan Haskell and Stian Westlake. I just looked up the name, Jonathan Haskell and Stian Westlake, Capitalism Without Capital. The fundamental paradigm and the center of what we're living through is we're living in the age of the mind. We're looking at empires of the mind. You shouldn't be needing a lot of money to build these businesses. And even in India, the really classy tech businesses don't actually need money. They throw off money. And I think the paucity of tech IPOs in a 11-year period actually underscores that. Just 270 IPOs globally in 11 years in tech, mind-blowing data. And I think the third factoid which stood out, I just doing rough maths as Kaustubh was presenting, roughly 1 in 6 of these IPOs actually make any money. So if you need a return above your cost of capital, assume your cost of capital is at least, say, 15%, basis Kaustubh's charts, from what I could see, 1 in 6 of these companies actually deliver a return on capital above cost of capital. And that stat actually tallies very nicely in India. So if you look at the last decade in our country, 85% of BSE 500 companies have given you a return below your cost of capital, below 15%. So 1 in 6 BSE 500 last 10 years, 1 in 6 roughly from Kaustubh's data, doing a rough and ready study. And I think it very nicely sets up the context that, yes, there is tech happening. It's interesting stuff, but it's not going to sort of shake the foundations of our lives. We will make money if we are sensible, discerning investors. 1 in 6 of these tech companies will make money for us. Like everything else in life, 5 in 6 will be a waste of time.
But I'll just pick up from there. I think Haresh is making the point that there is a remaking really of the economy and the ground rules of doing business, and the way that COVID has in some ways shaped our lives has fundamentally changed the trajectory of growth. Do you agree with that assessment? I'll first come to you, Saurabh, and then go to Haresh on that.
I think if you look at India over the last 10, 11 years, there's 3 sets of things that have happened. What's happened in India the last 10 years has happened in other countries before. But where India is unique is no other country has gone through this confluence at the same time, right? The first factor is the networking of the country. Plenty of people have written about it. Doubling of the highway network, 5-fold growth in domestic air traffic in spite of COVID over a 10-year period. When I migrated to India in 2008, 1 in 3 families didn't have a bank account. Now every family has a bank account, right? You've had UPI, you've had GST. So you've networked the country. Typically in any era, in any nation, when you network the country, you consolidate the industry. You kill the local and the regional player, and the industry consolidates in the hands of 1 or 2 companies. Secondly, as we have discussed, and as many other people have written about more eloquently, the rise of SaaS, cloud, and mobile transforms the ability of smaller companies, especially cash-generative smaller companies, can transform their businesses using low-cost, world-class tech. Through serendipity, no credit to us as a nation, but serendipitously for us, we've got low-cost, world-class tech, and small companies who are smart are using that to scale up rapidly in a way that wasn't possible, say, 20 years ago. And thirdly, just as powerful, I suspect without this, we wouldn't be having this lovely discussion, courtesy Morningstar, the attack on black money, right? The attack on black money, for whatever reason, it has gone on to full throttle. The RBI repeatedly points out 95% of Indian household wealth is in gold and real estate, right? While the central bank won't say it, I'm happy to say it, the bulk of that wealth, which has gone into gold and real estate, is black money. And by attacking the black economy, we're pushing money out of the black financial savings, black household savings, into white household savings. A mere 5% of Indian household wealth is in financial savings. Roughly, Indian household wealth is $10 trillion. That means 9.5 trillion is financial assets. 9.5 trillion, I'm sorry, is physical assets. As you toggle even 1 trillion out of that 9.5 trillion, as you toggle it into the financial economy, you're bringing down the cost of capital, making angel funding available, you're bringing down the 10-year bond yield, you're stoking the stock market. And the third factor, therefore, which is transforming the country alongside networking, alongside technology, is easy access to domestic capital, right? These three things have happened in other countries, but uniquely for India, they're happening together. And the impact is electric, and it goes well beyond technology. In 2010, India's top 20 companies accounted for just 30% of national profits. In 2021, India's top 20 companies account for 95% of national profits. We are consolidating the entire economy, not just things to do with rideshare and food delivery. We are formalizing and consolidating the entire economy. A part of that discussion in technology and a part of the spoils will go to well-run technology company. But there are many other very smart, well-run companies who are using technology, but ostensibly aren't technology companies, who are making a lot of money out of this epic consolidation of the world's sixth largest economy.
Saurabh, that is a fascinating area which we will have to unpack maybe towards the end of the conversation on what this means for some of the large established companies who are using digitization and technology as one now part of their core strategy. Haresh, I'm just coming to you. You heard the three drivers that Saurabh spoke about in the macro environment, that's part of the India growth story. I know you've been kind of very laser focused in terms of understanding how COVID has fundamentally changed the landscape. Walk us through what we're missing. Are we missing anything here, which is fundamental?
I would add one more factor to what Saurabh talked about. His yes. Whole discourse was excellent and absolutely perfect points made there. The other thing that's happened is COVID transformed behavior across the nation. And therefore, there has been a massive adoption. There's inclusion today. Companies can reach anybody living anywhere in India. There is this democratization and, all of that is cliched. But the bigger thing is that when you make supply available at a fraction of the cost, make it easily accessible, make it a tap away, make sure the payment is not a friction. As you remove friction from the market, the demand actually goes up. So what's fundamentally also happening is that we have to re-look at the entire addressable markets for these companies. So it's not as if, and that's gonna matter. So I'm not talking only about startups. I'm saying even well-run companies, as Saurabh was talking about, which are using digital technologies, they will suddenly, move away from the pack. They will move ahead because if they can make their product accessible, if they can, really go in for a mass, if they start thinking that instead of having 10 million customers, I need 100 million customers and working backwards, like startups do, the supply creates its own demand. And that's what we are seeing. Suddenly when you have meal delivery available in 500 cities, a logistics network spanning all pin codes in India, that a person can tap a phone and the UPI payment gets cleared immediately. You find that the demand and the desire to be participating in the larger economy, to become a productive. Now you see the people who are getting blue collar jobs sitting on an app, right? So all of those things have suddenly become available. So that's the other, I would say, fourth element of this transformation that really COVID has accelerated. And the people who will gain from it, clearly our IT services companies are going to gain from, getting global demand. That's one big thing. Our established, formalized companies are already winning because GST came and gave a hit, demonetization gave a hit. Overall, the way the economy is getting restructured is helping them along in terms of consolidation. And the startups that are bringing in new technology and new ways of consumption. So I think one of the things is that we are making it available to millions of people. The whole market earlier was the India 1 market, Now it's India 2 and India 3 and India 4 participating. So you'll see a lot of growth stories, even for pizza, for example. If you see the growth that's coming in for a Domino's, or you look at what's happening to Nykaa or Flipkart or Myntra, the market size has transformed itself. There was a X number of consumption, people who consumed, and with A, Y frequency, both those numbers are transformed dramatically. The number of people participating has gone up, and the frequency of consumption. That's why I said, when we are doing 10 million meal deliveries a day, there are probably 200 million Indians who could probably order in a meal a day. And look at what it does to the market dynamics. And again, if you look at I'll give you an example of a traditional company. Asian Paints takes, let's say, 7 days to paint a house. And therefore, you paint a house once in 5 years. Imagine if it made it accessible that you could paint the house in a day. The demand for the company completely transforms itself. The whole addressable market changes, both on number of people who want to participate and the frequency of consumption. I think that factor is like an underlying factor. And we have to remember that the technology helps companies, collaborate, which was never possible in a traditional company. When you order a Ola cab, it collaborates with the Google Map who's done the mapping here. It collaborates with a Google Pay, which makes the UPI payment. So that unique, again, capacity we have to appreciate, and even our traditional companies need to appreciate, that technology allows this whole network effect to kick in and companies to collaborate. So one is being built on top of the other. And therefore, when something new is created, when UPI is launched, when, let's say, Pay Later becomes big in India, it will transform the consumption of goods. Today, if you look at what Pine Labs is, it's a company that really is taking off on the Pay Later phenomena. And people are walking into a store, seamlessly being able to buy their TV on a 6 EMI, 12 EMI, 36 EMI, seamlessly. I think that seamlessness, the value it actually releases, is what we have to start appreciating, actually.
Thanks, Haresh. Before I kind of open up the conversation, just one housekeeping rule, which is that we like to keep this interactive. So all of you who are kind of listening in to this conversation, you do have a Q&A box, I think. Do tap in your questions, and it will miraculously, thanks to technology, reach us as well. We will curate and pick up a few, which I'm sure the panelists will be happy to take on. So I think we've got a good big picture view of what this really means, what's driving it. I think let's get down to the brass tacks. I think, Saurabh, I wanted to pick your brains in terms of when you start unpacking some of these companies who are kind of going on to the IPO bandwagon with a very strong internet digital play, right? How should one think about categorizing them? What's the best way to unpack the large? It's not a homogeneous mass, I'm guessing. So,
sure. So I think there's sort of 3 or 4 things which we look at quite carefully, and as more of these IPOs come out, I'm sure, like everybody else, our thinking will also sharpen. I think one of the sort of first challenges to address is the way accounting works, unfortunately, doesn't help us as an investor. If we were setting up a simple, say, power plant, we could set up a power plant, say, in Tamil Nadu, generate cash from that, and then set up a power plant in Maharashtra, and we would report it to the stock market saying, the Tamil Nadu power plant is cash generative, our operating cash flow is positive, but hey, we are doing capex in Maharashtra, and therefore overall the company is consuming cash, right? But you'd be able to see as an investor that Tamil Nadu, Saurabh's company, generates power profitably. Maharashtra, they're putting in a new plant. Unfortunately, that distinction is not possible with these companies, right? And as a result, if I was a naughty promoter of a tech company, I would keep saying that, look, believe me, Indrajit, believe me, I am making money in Tamil Nadu. Trust me, I'm making money in Tamil Nadu. The new cash that you're giving me as a VC or as the stock market, that is going to finance the Tripura expansion, right? So a fair bit of our diligence around these companies is, have they actually made their original areas of dominance cash generative, or do they actually have no cash generative elements of operation, right? The more transparency we see from the companies in this regard, obviously the greater will be our faith in their future prospects. Because I'm quite happy, I'm sure everybody is happy to give money to a company which has shown that it can conquer a part of the country before it goes forward. Linked to that, second point is, historically, from what we have seen, the best tech businesses actually don't need much capital, right? So famously, .com, Sanjeev Bikhchandani and team made it cash generative on as little as, I think, $2 million. Right? That was a while ago, different India. But even more recently, right, you've seen the Nykaa team come to profitability on some, I would say, well below $50 million. And I was listening to the Policy Bazaar promoter speak, and they are saying that they built the company on $70 million. And these are three-class businesses: Naukri, Nykaa, Policy Bazaar. So whenever we see any tech business asking for a ton of money, obviously the skepticism meter in Marcellus shoots up, and then it links back to the first point. The third thing we're looking for is stability in the leadership, right? So a lot of these tech companies seem to sort of resemble revolving doors, that every 2-3 years, a kind of new pack of people coming and have a go, right? Somebody cashes in, somebody cashes out, all of that jazz. We need to see stable leadership. We are seeing that in some of these tech companies, you've got very good discipline around cash generation, very good discipline around capital allocation. You've got a stable leadership team which over a decade has built what is fundamentally a sound operation. It just happens to be in the tech space, but it's fundamentally a class business with strong moats. And with corporate governance, hygiene, succession planning, and team dynamics nicely in place, you then go ahead and invest in it, knowing that the business actually has moats. Obviously, the opposite extreme is what I call putting lipstick on a pig, which is businesses which are fundamentally unviable, but they represent themselves, they kind of polish themselves up and present themselves to the stock market as a tech business. But nothing wrong with that. That's the nature of free market capitalism. As Kaustubh data showed, and as our study in India suggests, only 1 out of 6 of these plays will actually make money. Out of the other 5, some will be pigs putting a layer of lipstick on themselves, and perhaps some of them will be honest triers, but who didn't quite get the business model right. So I think standard old-fashioned skepticism works, and you just have to realize that business rules very rarely change. This notion that tech fundamentally changes the rules of business, I don't think is true. You just have to re-understand the accounts and ask the company for help so that you understand where did they generate cash and where are they using cash. The standard IFRS or Indian accounting standards are not going to help us there.
Sort of the very, very interesting points, one on frugality, the other in terms of stability, governance, transparency. Now, these are fundamental issues, right? However, the point you made about the stability of leadership, say, for instance, right? Startups they believe that they should get some allowance for the kind of creative destruction that one could possibly see if you allow business models to be revamped, remolded, and quickly change track. Now, and things don't always turn out the way that you planned initially. So, Haresh, I was just kind of coming to you based on what Saurabh was saying. Is that allowance a fair allowance to give digital companies and startups who work very differently from a mainstream traditional company?
No, I absolutely. I think these are high-risk businesses. So anybody putting in money needs to realize that all these factors that Saurabh talked about are all up in the air a bit, and a bit will wobble as the company finds its feet, finds its moat. And remember, the moats of digital companies are much easier to attack because you can take a company with 1,000 people who deployed it, and 5 engineers can rewrite that code and really hurt them again. So the even after the best run company, the best frugality and the best business model and the best moat, you can be disrupted overnight. So I think that's the other thing that we need to remember. You can become a feature on Facebook, right? You can become a feature on Google. You can become a feature on WhatsApp. So I think there are inherently it's a high risk business, and therefore somewhere we need to also give them the leeway that these guys are struggling, and some of them, the founder conviction actually builds these companies. So you have Kamath at Zerodha. I mean, look at what's been built there. I look at Elon Musk. You can't take these people out. And equally, you have examples of the CEOs of WeWork and Uber, right? Or the founders of WeWork and Uber who were thrown out. So these risks will, it's very difficult to imagine what's going to happen. Therefore, you need to come back to the basics as Saurabh is talking about. Look at their business model, look at where the cash is being used, but also understand that they are fundamentally in a position, as I said earlier, to one, rewrite the addressable market. For a Zomato or a Swiggy or a Zerodha to add a new customer and service them is virtually marginal cost is nearly zero. So I think that's what we need to appreciate. That the marginal unit economics of these companies are so attractive. We need to understand, are they really building up their fixed cost structure? Because fixed cost structure, which traditional businesses actually abhor, is actually a moat builder here. Amazon's biggest moat is the fact that it has the fixed cost built up to serve prime customers and can deliver a toothbrush to you virtually at negligible additional unit economics, actually. So we have to appreciate some of the nuances that are different from the traditional companies, that fixed costs are the great thing. The marginal unit economics are fantastically, are fantastic actually. If you look at adding a new restaurant or adding a new customer or servicing a new customer for a food delivery business, once it crossed a size and scale, I think we need to remember what the stage of the business also important. When you're going to invest, assuming all other factors are given, is the business already in monetization mode, or is it still in distribution and market share and winner take all mode? I think that's important. Google Photos stayed free and destroyed the entire photo sharing industry by staying free for so many years. And suddenly Google decides to not include it as the part of the 15 GB free it gives with the Google account. Suddenly, maybe it's 15 years later that you suddenly have a multi-billion-dollar cash flow coming from this little asset because of the stickiness it generates. So again, I think the rules are a bit different. Marginal unit economics, how strong or weak are the network effects, how deep is the customer engagement, and the optionality it generates. As we saw, Nykaa is a perfect example of optionality, where selling to the same women, they have the data, they're able to use it, they're able to transfer that audience at virtually zero cost to buy apparel. Again, a high AOV, reasonable margin business, or zero da, frankly, whether it gives away the brokerage fee, but you can see other financial products evolving on that platform. So some of this will require creative visualization from the investing side as well. I mean, you can't beat them with the same stick that we beat traditional companies with, because fundamentally they are building out a different future. And the market addressability is what's driving. Look at Freshworks, global IPO. Company sitting out of India builds, and multiple new companies will come in that space. So again, that whole market size definition, I mean, we've been stuck traditionally with what we thought was a market size for a company in India, but these companies are in a position to influence that. And that's one factor that we have to keep on take into account.
So Saurabh, do you believe that we're kind of beating these companies with an old stick in some ways, or is there a need now to reassess and take a whole new lens, which is what Haresh is arguing, at least for the quality companies in this pack, not all, I'm guessing.
No, so I think Haresh's insights were actually fascinating. Look, I've become after 13 years in India, I've become a sort of a hard-nosed dhandebaz, right? So when I meet a promoter, my simple point is, "Mere ko paisa bana ke dikhao, Malik," right? Whether it's sticky, unsticky, network effects, whatever effect, jo bhi hai, show me where you make money, right? And the moment you sort of start hearing me, it's unit economics. So Haresh, unit economics to my mind is a red flag, because the way you define the unit is obviously...
No, of course you need to do deeper analysis. Absolutely. But I'm saying it's not visible, absolutely not visible in the accounts actually.
So just to sort of link back to good old-fashioned fundamentals, when I first moved to India 2008, InfoEdge was a tiny company then. I think that listed in 2006. But already Naukri.com was generating cash flow, right? Linking to Haresh's point on, can you hear me, Indrajit?
Yes.
Yeah. So linking to Haresh's point on network effects, already back in 2008, we realized that InfoEdge or Naukri was a national dominant player. So whether you were an HR head in Bangalore or an HR head in Noida, you subscribe to the Naukri database. And therefore, whether you're a youngster in Delhi or in Bangalore, you put your CV into Naukri, right? And because Naukri built a national dominance within its first 10 years on very little money, subsequently, it's been an unchallenged player. It's been difficult for whether it's Monster or LinkedIn or others to really give Naukri a run for its money. In contrast, many of the tech players today are building local dominance. And as a result, if you might be great in Mumbai, but somebody else usurps your turf in Hyderabad, because your Mumbai dominance gives no benefit in Hyderabad. So if you're able to find frugally run companies building national dominance on the back of technology, on the back of a high-class team, of course, you and I should invest in it. And usually such teams are able to very clearly show you how the dhanda makes money. On the other hand, if you and I are running into teams who are building local plays, that too with with sketchy unit economics, and they're raising further money to build out other markets, that immediately suggests a shallower moat, a weaker moat, and more questionable future prospects.
Yeah, Saurabh, I just kind of pick up a couple of things that you spoke about, and
I'll just interrupt. Come in there. We should also remember that there are digital companies. National Stock Exchange, when it's the digital company, so we should not just look at the these younger startup which are whose business model is not yet matured. We should make a set of companies that are CAMS is a digital company, CDSL is a digital company, MCX is a digital company. You'll find many traditional companies actually add on, let's say, digital boosters to their business models. And therefore, I think the basket needs to be looked at as not, the startup company. We should look at digitally powered, data-driven businesses, which will create enormous value. Because once you get this formula that you can affect your market size, you can affect your opportunity, you can cross-sell, you can upsell, you can build on other businesses. I think you fundamentally rewrite the rules of the way you do it.
Just to echo Haresh's point, outstanding book on this subject recently written, I think published a month ago, The Brains and Brawn Company, Robert Siegel. And is Charles Schwab a digital company, or is Charles Schwab a gigantic money machine which makes money digitally, non-digitally, from stockbroking, from wealth management, from fund management? At one level, I think investors like us don't care. We focus on the monopoly, we focus on the cash generation and the dominance, and Charles Schwab gives it to us digitally and non-digitally.
Absolutely. I think
Haresh, I'll just take a pause here. I think there are some questions that have come in, and I'll surface them because I think they're well timed in that sense. So Vinay Singh is essentially asking, with no actual physical assets on the ground, or at least minimal assets on the ground, would these internet companies sustain our long-term agenda for investments?
So I think it depends on, again, the context of the business. Again, Amazon is building physical assets, warehouses, gigantic ones, right? So it's not, we can't take one ruler fits all, that, these companies need to be capital efficient and need to be built with less investment. Depends on the context. Amazon's moat is the fact that it's done things physically, that people hated to touch and handle goods, handle returns, open packets, reseal them. So depends on the context of the business. Again, some cases in India, that physical infrastructure was missing. Today, when you order, when you get a delivery from Dunzo or a VFast, actually the infrastructure has been actually built by Swiggy, Zomato and their predecessors. So what really happens is that, again, I said this needs to be examined in every sector. Some businesses, India is so fragmented in several markets, so fragmented. Look at what's happening with a company called Infra Business, right? Which, if I can't recall the name, but which is really connecting up all the cement retailing and construction equipment, right? So one of the opportunities in India, which is clearly glaring, is the fact that we have fragmented, undercapitalized supply chains, undercapitalized companies, very local players. And therefore, digital company coming in has a natural advantage. It can use capital actually very efficiently to change consumer behavior.
Sure.
And therefore some of these losses that they incur are going towards changing consumer behavior. The challenge for the investor is to see whether the consumer behavior change is sustainable, if it is repeatable, and will it become profitable sooner than later. That's the point. I don't think that I come with that strict idea that these need to be low capex businesses, because some of them, look at our market, look at the state of the market and how much of it has to be built. Look at retailing. 95% of retailing in several categories is still general trade in kirana shops, not in modern trade.
So, Haresh, I'm going to stop you there. There are quite a few other questions, and I'll like to kind of surface them, because
Nifty is indeed 70% old style, steel and metals mining and power and infrastructure and public sector entities. So the index doesn't yet reflect the economic realities, and it doesn't take an equity strategist to figure out that the disconnect is a huge opportunity. The Nifty as an index, and I've tried my best to make this point to the establishment. The Nifty doesn't reflect the realities of a vibrant India, where intellectual property, the mind, rather than physical assets on the ground, drives wealth, drives compounding, drives the future of the country.
Fantastic. That's
I would add only one more thing there. I think in the West, all companies have to grow up eventually, and all the digital companies also will have to grow up. They'll moderate their growth rate. They'll become size will beget complexity, and therefore they will moderate their growth rate, and the multiples will come down to sensible ones. Microsoft, Apple trades at 12, 13, 14, 15 times EBITDA. It's not trading at a great multiple, even though it grows. So I think the other thing also the maturity of the system. Yeah. So it's a bit of time before we have really large tech companies that can go and change the structure of our index and markets.
Fair point. So there are two questions that I'll kind of punch together for both of you, and you might want to take a stab at it, either of you to start with. I think that we're experiencing some issues with the audio, but I think we'll probably get it fixed shortly. So Subhaya is asking, will price to sales valuations become the norm going forward? And Subramaniam Kannan asks, are these internet stocks really profitable, and how do you weed out the bad ones? So I think they're two different questions, but will the both of you want to quickly address this whole issue of what lens to look at this?
I'll take the one on price to sales. On the second question, Haresh, I think your wisdom is probably yes. So I think no price multiple, PE, PB, price to sales, the price multiples have no utility at all. Whether it's in old economy, whether it's in new economy, whether it's in Bulgaria or in India. So anybody out there who invests basis price multiples, I think you're making your life very difficult for yourself. What any investor, whether you're investing your hard-earned money yourself or your fund manager, has to do is build a picture of how long can the investee company sustain strong cash flow generation. So, for example, just taking any company anywhere in the world, if you can grow cash flows at 25% for the next 5 years, and thereafter your cash flow growth fades away to say a perpetuity of 5%. If you can just grow for 5 years really strongly and uske baad there's a fade, you shouldn't be paying in crude parlance any more than 25 times current earnings. But if the same company can sustain strong cash flow growth for 20 years, say 25% cash flow growth for 20 years, which incidentally several companies in our country have done. Titan has done it, Pidilite has done it, Asian Paints has done it. If a company can sustain 25% cash flow growth for the next 20 years, even a basic Excel will show you that a 250 PE is also cheap. So the fundamental job of an investor is to reach a conclusion on how long can a business generate cash flows. Is it 5 years? Is it 15 years? Is it 25 years? The job of an investor, whether it's an amateur investor investing his hard-earned money or a fund manager investing on behalf of somebody else, the job of an investor isn't to look at price to sales or price to book or price to earnings. And as soon as someone does that, you know they're on a slippery slope.
Right. No, that's very well put. Haresh, on the second question from Subramaniam Kannan, how does one weed out the bad stuff?
I think on the parameters Saurabh spoke about. I mean, at one level,
So how do you kind of do this? How do you do this?
I think, as I said, one needs to understand: is the customer? See, I think we're in a new paradigm. Let me give an example now. If you're in Lakme or a Maybelline, and you're a marketing head there or a CEO there, and you ship out, let's say, 1,000 cases of red lipstick, you're actually not sending it out to a customer. You're sending out to a CFA or distributor. You have no idea when it's used, who it reaches out to, how much stock is lying there, whether this person has already had a red lipstick before, will she ever buy something red color again? You have no connection at all. We believe you're doing marketing because we run an ad on TV and then we ship out to a CFA or a distributor or a dealer, and it goes to a retail shop somewhere, it sits somewhere on the shelf, absolutely driving blind. I think that new paradigm now is very clearly that companies are developing models and understanding how to engage customers. So when Nykaa does the same thing, it knows who's bought the product, it knows what price point of the 10 red lipsticks it had, which price point did the customer pick, what they bought before, they can influence what they buy later. They build a continuous engagement model. So the profit is not profit. See, when a Lakme or Maybelline does it, they want to think about profit made from that one lipstick. When Nykaa or a new age company does it, they think of profit from that customer. I think that fundamentally you have to rewire that these are not companies, and if the company is doing a transactional business while being on the internet, it's a bad company, clearly. If it's building engagement, if it's looking at a multi-frequency, higher frequency engagement, you will build value. So I think we sometimes get confused that this company is using digital tools and it's a digital company. It's not. If its customer relationship is not engaging and not repetitive, if it's stickiness, which is, the exit cost for a customer needs to be higher. There should be reason for a cost to be paid to leave the system. Look at Google Photos. You cannot leave Google Photos anymore. You cannot. Very simply. All of us are going to pay a few dollars for it to hold our photos there. That's it. It's a monopoly at ab initio, the day it started charging. So I think some of these factors need to be looked at. We can't just take a company and look at its numbers, because two companies having the same P&L, one could be on its way up and the other could be on its way down. I think, and that phenomena earlier in the older world, companies had time to die. I think companies won't have time to die anymore. They'll die even faster. So they're growing faster, they'll die even faster. So I think we need to dig deeper and look at the fundamental relationship the company is able to build with its consumer. Do consumers have a great NPS? Are they willing to transact with it more? Are they trusting it to buy other products from it? And is it able to rewrite its addressable market? So if those factors don't come into play, then the bad company, as I said, on those factors that, promoters are stable or not, all those factors are there. But even beyond that, you need to look at the fundamental model. And we see a company here. There are several second-hand car businesses in India. Some of them listed, some of them that will get listed. In the next 2 years, you'll discover very clearly which were the bad models and which are the great models. And it will not be just a function of whether they had more capex, less capex. It will be a function of how they reset customer expectations and created delight.
Got it.
So some companies are making second-hand car sales a transactional relationship, and some companies are converting them into a multi-tiered relationship. And that's going to be...
Hold that thought, Haresh. I'll just come back to you. There are many examples now, especially, large conglomerates who kind of now seized of this opportunity of digitalization and changing their fundamental portfolio, as it were. The Reliance Group and the Tatas are good examples of that. I'm sure you're tracking other companies as well. How is that conversation that you have with some of these conglomerates and large established companies changed, if at all? And what questions are you asking them now?
So I think a conglomerate and the sort of detail and brains required for the sort of work Haresh was describing 2 minutes ago is sort of mutually incompatible. A conglomerate was created in our country as a way to address two issues our country faced through the 70s, 80s, 90s. One was scarcity of capital, right? Clearly no longer a problem. Right? A conglomerate basically made money in X industry and transferred it to Y industry. That's no longer an issue. And the second reason for a conglomerate through the 70s and 80s was political access, right? Access to the ecosystem, and especially in Delhi, in the license Raj, having the right contacts in Delhi were essential. So both of those factors are less relevant today.
Sure.
And hence the conglomerate in India largely is a declining force in corporate life. Like everything else, they'll try to latch on to whatever they can, right? So, internet being the latest thing, but it is not, it rationally doesn't stand to reason. Haresh gave a lovely example of lipstick, right? If you are going to be selling lipstick through e-commerce, it's a fundamental rewiring of how you sell lipstick. It's not just a question of saying, I'm going to sell lipstick by advertising it on the internet. Right? The way the supply chain works, the way the head of marketing works, the way marketing and manufacturing interfaces utterly changes in a digitally run lipstick company. A conglomerate cannot do that. A conglomerate can't go back to its empire and say, boys and girls, we're going to rewire the whole thing because of this new thing.
So we are making an attempt to do exactly that, what the Tatas are trying to do.
So I'm sure there'll be sincere attempts, but to rewire a conglomerate, just to take an example, to rewire a conglomerate to give, say, to compete with Nykaa, or to rewire a conglomerate to compete with Amazon is an Herculean task.
So what I think drove the flood of global investors to invest in Jio, say, for instance?
So you'll have to ask them. Our take has been quite simple, right? If you look at India, look at businesses which are generating substantial returns on capital well above their cost of capital. It's because of focus and detail. The part of that detail is their tech strategy, acquiring data, analyzing data, locking in customers, repeated engagement. So whether it is Bajaj Finance or Asian Paints, tech is at the heart of their dominance. And they've combined that with highly focused management teams, which just focus on getting one thing right. A conglomerate, by definition, is straddling many industries. If you take a typical Indian conglomerate, they'll have 2 businesses which make money and 20 that lose money. And life for them is a constant balance of keeping the fires going in the other 18. In that context, the internet comes in as one last band-aid to see if something can be salvaged from the other 18. And, I'm sure some of the...
Saurabh, just to butt in here, look at the Indian banks. Money has been digital for last 50 years in India. But the same bank doesn't give me the home loan, car loan, savings account, and I don't use it to pay my daily payment. Every banking app has a scanner for QR code.
Yes.
It's not used at all.
Right.
Because the bank is not wired to serve me. It still thinks of me that I am a customer for home loan separate from an auto loan. I'm not a customer. I am a customer for each department.
Right. Yep. Nicely put. Siloed relationship in Indian banking.
They just don't have the DNA to look at us as one.
Yeah, so it's going to be pretty fundamental. I mean, if someone can pull this off, that will be perhaps a first. We saw what GE was trying to do, and we know what happened with GE.
So another way of putting this, Indrajit, is the conglomerate is used to IT being a department.
Yeah.
Yes.
The conglomerate is not used to IT running the company. The CEO says, boss, I am the boss, you are the head of IT. And in the new world, the head of IT is the boss. Right? The CEO might not even have a job.
Okay. So we have 5 minutes to go. I thought it would be useful to spend a few minutes with each of you to give us a slightly future forward kind of perspective. Where is the puck really moving? What are the opportunities that you think are going to be big from a tech digital lens? What are these themes that really should be of interest to from an Indian perspective, because we're concerned with the opportunity here. Saurabh, would you like to go first, and then I'll go to Haresh?
So look, I think the opportunities will abound in India, right? So in 1989, V.S. Naipaul wrote a book called India, A Million Mutinies Now. So I wish the great man was around. He would write a book today called India, A Million Opportunities Now. Right? Why are there a million opportunities? Because just as we've seen in the stock market, right, a relaxo consolidates and formalizes footwear, a titan formalizes and consolidates jewelry, and Asian Paints and paint. Similarly, we can just sit here for the next 10 minutes and we can rattle off 100 industries which need formalization and then consolidation, right? So jaggery, good to begin with, agarbatti to go on to, for people like me, Bangali sweets could be a third area of formalization and consolidation. But the opportunities will abound. And as I said 45 minutes or so ago, as you network the economy, you crack down on black money, and you bring low-cost, world-class technology to the table, Indian entrepreneurs will be up for it to formalize and consolidate, right? So one of my favorite formalization and consolidation, I'm really thankful to these companies. So for years, I used to be sent by my wife on hot Saturday afternoons to go and buy meat or fish. It was one of those most difficult journeys. 2 o'clock, you find a parking spot. You go to some vendor whose hygiene was questionable. God knows where the stuff came from. Now, with a click of a button, we get fresh meat delivered to us doorstep, and there are multiple vendors doing it. So there's Lush, there's Meat to Go, there's Fresh to Home, right? So simple example, you formalize a hitherto fragmented and informal industry, and then you consolidate and you create wealth. You have happy customers and happy shareholders. So there'll be many more of these. Technology is nothing but a via medium. The bigger story, the story of the decade, I would submit to you, is the formalization and the consolidation of this giant economy.
Terrific. Haresh, what are the...
I think this whole idea that we are fundamentally been undercapitalized. If you look at it, too many brands, too many companies, all running subscale, inefficiently in several markets. So it's just a question of coming in there. And I said, I'm not too worried whether a great company got built for $100 million or $500 million. It won't matter in 10 years if you build a $50 billion company, right? So every market, if you look at agri, healthcare, and some of these assets are the farm easy, let's say, Thyrocare deal, are some signals that we're getting that it's not necessarily tech versus traditional. It's actually tech running traditional. I think some of those stories will emerge because you will find traditional companies really suffer. They will have operations on the ground. They'll have knowledge and expertise that some of these traditional companies, new companies don't have. They'll have the trust of the consumer. And when you really digitally power them, and several will fail, but all the experiments we're talking about are just happening today. And some of these will result into huge value creation. And opportunity exists in every part of the market. Getting blue collar workers is getting consolidated. Getting worker insurance, hiring them for projects, all of that is furniture. We never realized that a big, huge business could be built by helping middle class Indians build their homes. Because there's so much uncertainty when you hire your own carpenter, own interior decorator, you don't know what material you're getting. You put that together, you put a nice digital layer around it, give people faith and trust, remove friction, and you build massive scaled businesses. It's fascinating to be a part of this in our generation, actually, for all of us.
Yeah. So we're obviously, based on what both of you are saying, at a very, very important inflection point. And I'm glad that we had this conversation, because I think you've also sifted out the real opportunities from the ones that are perhaps dud, stories that will not fly going forward. I think the fact that both of you have used a very strong thesis and how you kind of value these companies and how to look at them with a fresh pair of eyes, I think should be instructive to all the participants who've tuned in. We've been able to pick up some questions from the audience, but Kaustubh's report that we started with will also be ready very soon. So you will get a global perspective, a data-driven kind of global perspective, which is worthy of, I think, study. But I think what we've heard today, both Haresh and Saurabh very eloquently map out are some of the key drivers, how to separate the good from the bad, and where the puck is moving in some ways, because that's really one way for smart investors with a new set of lens to look at and reassess this opportunity. So I'd like to thank both Haresh and Saurabh. It was great chatting with you. And thank you so much.
Pleasure to be here.
Thank you. And thanks Morningstar for this opportunity. Bye.